Hello everyone. Welcome to Eyeing the Future Trends to Watch from Esri's 2017 to 22 demographics. To kick things off, please take a minute to answer a couple poll questions, then we will review the results. Thanks for participating in the polls. It was interesting. It's good to know that over 90% of the folks on the call today on the webinar, your companies use demographic data, which is very encouraging. And for us, it'll be interesting to share how we at Esri can help you do that. And the other question, only 75% of you have actually used Esri demographics. So we're hoping we can encourage those that already use our products to use them even more, and those who haven't used them to increase their usage or at least get familiar with what we have. So welcome to Eyeing the Future, Trends to Watch from Esri's 2017 to 22 demographics. I'm Brian Peterson, a Senior Product Marketing Lead at Esri, and I'll be your host for the webinar. Before we get started with our first presentation, let's review a few housekeeping items. First, the webinar is being recorded and you will receive an email that includes a link to the recording. During the webinar presentations, please send us comments and questions through the questions panel. We have dedicated some time near the end of the webinar to answering your questions. We have a great presentation for you today. Esri is the world leader in location intelligence technology. One of the game-changing benefits that our users receive is the extensive content included with the ArcGIS platform through the Living Atlas of the World. A prominent portion of that data are Esri demographics. Lynn Wombold is the Chief Demographer and Data Development Manager at Esri. She is one of the foremost experts in the field and leads a team that is tasked with the processing of census data and the development of unique databases such as updated demographics, consumer spending, retail marketplace, and Esri's proprietary Tapestry segmentation market segmentation system. She has some enlightening insights for us today. And now I'm going to turn it over to her and let her take it away. Thanks, Lynn.
Thank you, Brian, and welcome to Data 2017. Today I'm going to be presenting some of the trends that are reflected in our latest release, 2017 Demographic Updates for the U.S. I'm going to be looking in particular at the patterns of growth, where it's occurring, which areas are growing and why, and what some of the effects of these changes are. Not all growth is beneficial. Whether it's good or bad can often depend upon your perspective. If it appears we're focusing on growth, it's because that's the primary interest of our data users. Yes, some users are definitely focused on a particular attribute, a level of income or a special population such as retirees or children. But if that's their initial question, I guarantee you the follow-up is, how fast is it growing? Hence the emphasis. If you want to eye the future to know which trends to watch, you need to begin in the past. Past and current trends are critical. Demographic change is very rarely random. What this chart shows are the basics: population, households, and housing units, the beginning of the updates. The one thing you can notice here is that over time, I'm showing you 3 different time periods here, back to 1990 and up through 2017. Population is gradually decreasing. This is nothing new. What's interesting here, though, is that the relationship between population growth, household change, and the change in the housing inventory is changing. And that change is often key to the trends. Start with 1990 to 2000. As you can see, household growth was dominating at that particular point in time, even faster than the population growth. Why? Because the average household size was dropping. Birth rates were lower. The crude birth rate, which is just total births divided by total population, went down 15%. The general fertility rate, which is a bit more specific to women of childbearing years, went down 9%. Additionally, we had a lot more single-person households. The effect of this was to put serious pressure on the housing market to keep up. Move forward to 2010, and as you can see, the housing units are dominating. Now, there is some pressure on that. The millennials, which is the largest generation, were entering the household formation years at the time. However, that got amped up by select economic changes. At the beginning of the decade, there was a dot-com bust, followed closely by a recession. Interest rates were low. That encouraged real estate development, aided and abetted by increasing home value. As it turned out, it was too much of a good thing, and ultimately ended with the collapse of the housing market, the Great Recession, and a good time for all. We had a serious increase in vacant housing units and much slower growth in the housing inventory by the end of the decade. Now, currently, of course, population growth is still slowing. That's our consistent pattern, but not as much as households or housing units. Births are still decreasing. Crude birth rate is down another 4.6%. General fertility rate is down 2.5%. And the millennials are still hitting the household formation years. It's a very large generation. But household growth is still less than population. Why? Average household size is now increasing. Not across the board, and slightly in some areas. But it's an increase due to both family households, more multi-generational families, and non-family households, more roommates. What's curious here is that the housing inventory is increasing at the same rate as the households. We'll be coming back to that trend. So, where is the population growth? Here we're going to use metropolitan, micropolitan, and non-metropolitan areas. It's the simplest way to view patterns of change in the U.S. population. By the way, I am using current definitions of each of these areas. So why use a metro, non-metro distinction? Well, if you want to go to the state level, you've got 50 different states. If you prefer the county level, there are 3,142 counties. Good luck with that. Metros and micros comprise core-based statistical areas. They are defined by their urban cores and their socioeconomic ties to the surrounding areas. These are not just statistical or political distinctions. These areas share an economy and identity that distinguishes them from other areas and from non-metro counties. What you can see here is that the metropolitan areas clearly dominate growth, no matter what decade you're looking at. Currently, metros represent 86% of the U.S. population, and that is increasing. It's 96% of U.S. population growth from 2010 to 2017. Micropolitan areas are declining in terms of the proportion of the U.S. population, as are non-metro counties. The two conclusions you can draw here is, first of all, population growth is diminishing, and the presence of an urban core does matter, but the size of that urban center matters more. Another way to view the selectivity of the growth and its deceleration is to look at the number of areas with an annual average growth rate greater than the U.S. As you can see, the U.S. rate is declining. The slow growth, moderate if you really want to be positive here. Curiously, though, Although you might expect more areas to be able to keep up with this slower pace, it hasn't happened. The metro areas, in the past decade, over half of them were able to exceed the national rate of growth. Today, it's down to 42%. The micros and the non-metros are dropping back even faster. There are simply far fewer areas with growth rates that are increasing. So, the thing to keep in mind here, though, is that it's not just population growth that's declining. The population losses are also decelerating. Average losses from 2010 to 2017 are less than half 2000 to 2010. And it's not necessarily more areas declining either. 10% of the metros, 382 metros, you've got about 38 that are losing population. Micros, a few more of those are losing now. Non-metros, well, most of the non-metro counties were always losing population, but that proportion is declining too. The thing here is the population change itself is contracting. Natural increase is lower. Births are decreasing, deaths are increasing, and immigration, which was increasing a bit after 2010, is down 2015 to 2016. Because immigration is influenced by current events, it decreased during the Great Recession. And I'll go out on a limb here and say current politics and policies are likely to show a decrease in immigration from 2016 to 2017 too. What's more, fewer people are moving within the country. The change is contracting. It's been doing this for decades. You can expect this to continue. So, which areas are growing and why are they growing? A more measured pace of change does not preclude growth, but it does render it more selective. If the potential is diminishing, then you can expect areas with above average rates of growth to have an attraction, some sort of a draw. And that appeal is likely to vary for different populations. Some may be looking for jobs, others may be looking for better housing. Some may just be looking for a good place to go fishing. The characteristics of growth areas will also offer varied appeals. So, which areas are growing? Well, we've already established the metro areas are ruling there. What I'm going to do here is look at some of the traits that are commonly associated with growth. Take it a step further. We're going to start with employment. As you can see from this table, not only population size matters period with employment. It remains an advantage with the larger employment base. Metro areas are 86% of the U.S. population. They're 87% of employment. And that size advantage is reflected in the employment growth. We've gained 15.7 million jobs since 2010. Almost 93% are in metro areas. What's curious here, though, is that the unemployment rates are similar across all areas. Size doesn't seem to matter so much. Today, we see an unemployment rate that is comparable to what it was back in 2000, reported in the Census 2000. In some areas, for micros and non-metros, it's actually improved a bit. The metro is not quite back. You can see the spike in unemployment in 2010 following the Great Recession. Today, though, it's back down to where it should be. But the similarity of the unemployment rates is interesting. I can't say the same thing for labor force participation rates. Now, the labor force is simply total civilian employment plus unemployment divided by the population 16 plus. Labor force participation rates are less equitable by size, and they're a lot more age dependent. which is why I've included the median age in this particular table. As you can see, metro areas are youngest. The median age of 37.7, they are much younger than either micropolitan or non-metropolitan areas. And that's reflected in the rates. Metros have the highest labor force participation rates, much larger than micros or non-metros, but their median ages are already over 40 years. Half of the population is aged 40 years or older. The other curious thing about the labor force participation rates is that they haven't quite regained the levels they were at in 2000. To keep the focus on employment, we also like to look at an employment population ratio. This is just civilian employment divided by the population 16 and over. The same pattern shows here. The disparity is there. You can see it in metro, micro, and non-metro. And you can also see that the ratios haven't improved back to the levels that we saw in 2000. Bottom line here, the job losses due to the Great Recession have been reversed. But the age composition of the population has changed. The oldest baby boomer was 54 in 2010. Today the baby boom is aged 53 to 71, and they're retiring. Another characteristic of metro areas is income. They also dominate median household income and overall income levels. The median incomes are shown here 2017 and 2000. And what you can see is that the metro, yes, it's 38% higher than non-metro counties and 28% higher than the micropolitan areas. The average household income would show an even greater disparity. But the increases are there since 2000, and they do appear to be benefiting all areas. You're looking at 30 to 40% right across the board. Now this is growth over 17 years, and it's nominal. What does that mean? It means that growth in household income has not kept pace with inflation. That was 44% over the past 17 years. The green bars show nominal growth, total change in income. The red bars show the real income change. So there is growth. There's just not enough to exceed the impact of inflation. Real change in median household income remains negative. So, let's summarize. Looking at the traits that are commonly associated with population growth, we can see a distinct advantage to the metropolitan areas, except for unemployment. No real advantage there. Although these traits are commonly associated with growth, they are not common to all growing areas, nor are they prerequisites for growth. If an area is experiencing above average growth rates, there is a draw of some sort, an attraction for newcomers. That appeal is likely to vary for different populations. Keep in mind, not all migrants are looking for jobs. So, we're also going to take a look at a more intangible factor. Which is location. Location adds a qualitative consideration to growth and highlights some of the ancillary attractions for different areas. So, take a look at which areas are growing and why. These are the top 5 metropolitan areas for population growth through 2017. The fastest growing metro area is the villages. 4.1% annual average. However, if you look at the employment population ratio, it's less than half the U.S. And they're not exactly up there in income either. Median household income of $49,000 and change ranks them number 246 out of 382. However, a median age of 62 years pretty much tells you it's a retirement area. By age, 2 of these metros are attracting retired migrants. When you have a median age over 40, you can expect that there is a good retirement population there. The top 3 fastest growing metros also have incomes well below the U.S. median. In fact, they wouldn't even rank in the top 100 as measured by the median. And only one of the fastest growing metros has an employment population ratio that's above average. However, I think the estimate for Midland, Texas is a bit low. Keep in mind, our employment population ratio is based upon resident population. The primary industry in Midland, Texas is the oil industry. And the oil fields do tend to include a lot of non-resident workers. So that number is probably a bit low because it's residence-based. The other thing to note, I haven't included population in this table, but these areas, with the exception of Austin, tend to be smaller, under 500,000 or close to it. Austin is the only metro listed here with a population of more than 1 million, and they're at slightly over 2 million. The fastest growing metros do tend to be smaller. They have a smaller base and a larger percent change. So what are these metros showing us? They're illustrating a growing trend, which is baby boom retirement. It was paused by the Great Recession, and it's still really in its early stages. Which way it goes is still going to be open. However, the effect of retirees in the fastest growing metros should not diminish the importance of jobs and income as draws. That's what's pulling in the largest generation, the millennials. To really understand the impact of these trends, though, we need to consider one more variable, specifically the housing market, and especially housing affordability. So, going back to our original chart here, what we would expect is that housing growth would generally be a little ahead of household growth, population growth. Why? You need vacancy rates to enable turnover and change in the housing market. When the relationship among these variables changes, we tend to pay particular attention to the housing market. Lack of synchronicity with population or household trends can be a problem. For example, in the past decade, when housing growth was exceeding population and households, we also noticed that the change in home value was exceeding the change in income. We were observing double-digit increases in home value in many of the metropolitan markets. There was not a similar change in income. Now, the recession at the beginning of the decade produced lower interest rates. The Fed usually reacts to the recession that way, but that's not enough to explain the gap. Affordability, or lack thereof, was the first signal of trouble in that market. Add creative financing, really creative financing, and a dash of greed, and the housing market collapsed when the Fed finally began to raise interest rates. The fallout was amazing. Great Recession, a lot more vacant housing units, and housing construction slowed. When that recession ended, we had a surplus housing inventory and low demand. That didn't last, nor did we expect it to. All other things being equal, we expected the increase in demand for housing would continue at some point. Why? The millennial generation. Today they are 18 to 38 years old. They're well into household formation years. So with the surplus inventory, the expected increase in demand would not be a problem, theoretically. However, the balance is changing. When the recession ended, interest rates were lower, so was demand. Let's face it, homeowners had had quite enough fun. Creative financing had produced much tighter credit checks for all home buyers, but especially first-time home buyers like millennials. They began entering the household formation years, but the college-educated millennials were also carrying large student debts, and that had to be taken into account. Meanwhile, the supply of homes was decreasing. At the end of the recession, there were a lot of vacant houses on the market. There were foreclosures. There were homes that had been built but never sold. There were short sales from homeowners trying to get out of the housing market when interest rates went up. All of this presented a tremendous opportunity. Greatly reduced prices for real estate investors. Keep in mind the recession gave a good swift kick to the stock markets too. Substitute real estate investment and you've got yourself an opportunity. The immediate effect of low demand and the decreasing supply side advantage was tenure. The short-term effect of housing supply and demand and the imbalance has been a decrease in the share of owner-occupied housing units. Now this is one place where metros do not dominate. Owner-occupied units are far more prevalent in the smaller micropolitan or non-metropolitan areas. Why? Metropolitan populations are younger, they're more mobile, they tend to rent. But the share of owner-occupied units dropped right straight across the board. And it's still dropping. It hasn't changed. I've added here the percent change simply to illustrate that you can still have an increase in the number of owner-occupied units over the past 7 years and still have a decrease. That simply means that households increased faster than owner occupancy. Now the quickest way to illustrate this is to show you this map. All right, let's try this. What we are showing you here are two different maps. On the right is renter, the change in the number of renter-occupied households, 2010 to 2017. On the left, we're showing you the change, and these are absolute numbers. These are not percents. So owner-occupied on the left, renter-occupied on the right. Now, what the legend shows is anything in the orange or the red is loss. As it gets more yellow to green to blue, you are looking at a gain. That is the change in the number of owner-occupied households from 2010 to 2017. The renter-occupied households, as you can see, there is a little growth here and there. It doesn't mean the proportion didn't go down, but there is some growth, particularly in the West and along the coasts. But you're going to see a wholly different story when you take a look at the renter households. Here there is a little bit of loss here and there, not much. Mostly it's gain, and that shows you the difference between them. So, what's going on now? Housing affordability. Timing is everything, and the balance continues to change between supply and demand. Interest rates are still low, but everybody knows that the Fed would like nothing better than to continue to increase interest rates. They ticked it up 0.25% yesterday. They would love to declare the economy is healthy and start raising those interest rates, and they're well on their way. And housing affordability is very sensitive to interest rates. We've had more growth in household income as measured by the median. It is nominal, but keep in mind the change in the median doesn't represent all income brackets. If for more information on this, look at our 2016 trend analysis. So if you're a millennial and you're looking to move from your first apartment to buying a home, now is good. Unfortunately, the short-term effect of the recession reduced the supply of homes for sale. So we have demand increasing, but the supply of starter homes, not so much. Some of that is due to the bargain hunting real estate investors. Some of it's due to the construction industry. The collapse of the housing market and the economy depleted the construction industry. A lot of contractors went out of business. A lot of construction workers were out of work. When they started to come back after 2010 and the end of the recession, the emphasis was on increased renter occupancy. So initially they were focused more on multi-unit construction. Now that demand is increasing for single-family starter homes, the builders are facing increased costs, labor, land, and construction materials. And we still haven't seen the full impact of the tariffs levied by the current administration on Canadian lumber. So we have a situation where demand is up, supply is lagging. What does that do? That increases the home price. Now we need to check the balance too between income and home value. I've included 2000 to 2010 here, but that decade really is an average. It's an average of the tremendous increase and the fallout after the collapse of the housing market. But as you can see, from 2010 to 2017, we still have a situation where home value is increasing more quickly than household income, right straight across the board. But it's particularly noticeable among growing metropolitan areas. Income simply isn't keeping up with home value. So, what we have here is a map that will show the share of median household income that's necessary to make a 20% down payment on a home of medium value. As you can see here, the gray areas don't require, they show greater affordability. When you get to the coastal areas and the West, you can see that the affordability is dropping tremendously. Again, the warmer areas show that you need a much higher proportion of your median income to put a down payment on a home of median value. Most of the country is affordable, but the growing metropolitan areas, as you can see, are posing more of a challenge to the purchase of an initial home. So, we've got one more map to show you here on housing affordability. Now this particular map is showing you our Housing Affordability Index. It's just another view, another way of looking at it. What this is going to do is it shows, or the index takes into account household income and home value, plus costs like interest and taxes. We're trying to reflect the financial ability of a typical household to afford an existing home. We're assuming a 20% down payment again. Now here, a housing affordability index of 100 represents an area that on average has sufficient household income to qualify for a loan on a home of median value. An index greater than 100 suggests homes that are easily afforded by the average area resident. So the higher the index, the more affordable the homes. An index less than 100 implies homes that are less affordable. So, you're going to see a very similar pattern here with the Housing Affordability Index, as we saw with the percent of income required for a down payment. Most of the country is affordable. When you get to the growing areas, the coasts and the west, then you are going to see affordability decrease. For the U.S., Housing Affordability Index in 2000 was 132. By 2010, it had increased to 158. There's the drop in home value post-recession. Today, the 2017 Housing Affordability Index for the U.S. is at 129. It's dropping. It's less than it was in 2000. The metro areas are the least affordable. They have a Housing Affordability Index today of 122. It was 144 5 years ago. Micropolitan areas, of course, are much more affordable. The Housing Affordability Index there is 158 today, a little bit lower than it was 5 years ago. It's 161. Non-metro areas are the most affordable. The Housing Affordability Index there is at 173. It's about the same as it was 5 years ago, no change. And as you can see, most of the country does offer affordable housing. But the growing areas, not so much. So, what can we conclude from all of this? Demographic change continues to decelerate. That's nothing new. That is a longer-term trend. The slower pace of change does not preclude growth, but it does render it more selective. The traditional growth advantage favors metros. Size, jobs, income. Location is advantageous to retirement, to less traditional growth. But you need to keep an eye on housing affordability there. That is still displaying a lack of balance. The resolution won't be the same as it was in the past decade, but the lack of balance is there, and it is going to impact home value and tenure in the short run. The bottom line is that this is getting interesting. If you want to know what trends to watch, you need to keep an eye on the generations. The baby boom, second largest generation. When will they retire? Where will they retire? And then you need to look at the millennials' response to tradition and these current imbalances. Neither the baby boom nor the millennial tend to go with expected or traditional responses. What they come up with is going to get even more interesting. But if you're looking for growth, like most data users, those are the trends you want to watch. For more information about our data, our 2017 updates, and the various databases that we produce, there's your link. For now, on behalf of the U.S. Data Development Team, we wish you luck with your analysis And we thank you for your time today. Back to you, Brian.
Thanks, Lynn. Trying to get it to where everyone can see my full screen presentation view. I appreciate your time, Lynn, and your insights that you were able to give us. You know, Lynn just touched the surface of what's available with Esri Demographics and the ArcGIS platform. If you're looking to do marketing, site selection, supply chain management, insurance risk, facilities management, public safety, there are data variables that can really assist in helping you do that. If you have any, let's take a look at a couple of the questions that came across, and Lynn's still with us. She can help us answer a few of these. One question that we had was, how do you develop your annual data updates, and how often does Esri update its data? Is it always current with the census published?
Well, our data updates are done annually. How we do it, I can't even put that in 10 seconds or less, or 30 seconds or less. The link that I gave you for our documents will take you right to the update methodology. And that should answer most of your questions. Our updates always reset with the latest census. So the base of what we're doing now is Census 2010. And that will reset again with Census 2020.
Excellent. Another question was, how accurate is Esri data?
Oh, I think it rocks. But you don't need to take my word for it. Parochial perspective. We did an accuracy study. We didn't do it actually. A team of applied demographers did it, wholly independent of us. And that is also available on our website if you'd like to take a closer look at how we stack up in accuracy.
Okay. When we do our data updates, Lynn, each year, do we include the American Community Survey that gets completed on a more regular basis than the census?
Yeah. Oh, yes. The 2017 updates do include results from the 2015 ACS.
Good. Excellent.
It's not our only source, but yes, it always includes the latest from ACS.
Great. And just, you know, on the accuracy of Esri data, there was a recent independent study, and we have a link to that here, by some of the nation's top demographers, where we did rank #1 overall against a lot of other major data providers that are out there. So another question that just came in is, what type of economic data do you have? Is it fairly in-depth at the industry level?
Well, yes, the economic data, business data, is that the question? We license business data from Info Group. We do use it in a lot of our updates, like our retail marketplace, but our business database is licensed from Info Group, and yes, that's updated too.
Good, excellent. One question came across, and I can answer this one. How can we access the data? Is there a membership fee? The data is included. There's a lot of different ways that you can get access to Esri Demographics, and Lynn, you can add to whatever I don't hit at this time. But excuse me, I bumped my screen. We have one product called Business Analyst Online, which dives into the data and actually does a lot of analysis for you based on various queries that you might have. Another one is a basic subscription, an ArcGIS Online subscription that can be purchased, so that way you have access through the cloud. If you purchase ArcGIS Pro, the desktop software that we have, all of our data generally comes included with your access to the ArcGIS platform. So you get both the mapping and the visualization along with the data and the ability to combine the two. Did I miss anything, Lynn?
No, I think you got it there.
Good. Excellent. So great. I just wanted to thank everybody for attending today. If you have any additional questions, please email us at the addresses on this slide. When the webinar is finished, you'll be prompted to complete a survey. Please take a minute or two to answer those questions so we can continue to improve our webinars. Don't forget to follow us on Facebook and Twitter. The Living Atlas has a lot of updates. Like I said, today we touched on the demographics. There is a lot of geographic data and content in there, including imagery and variety of other things. And as mentioned earlier, the link to the recorded webinar will be sent in a follow-up email to everybody. So again, thank you for joining us today. We appreciate your time and look forward to speaking with you down the road. Thanks.